Valens Research, Uniform Financial Analytics.
Right, Apple, which is the second largest company in the world after public company in the world, obviously after Saudi Aramco, at over $1.4 billion. And for Apple, what's so powerful and what's caused the company to generate such strong valuations is because the fact this is a company that has consistently been able to grow while also having robust returns. But one of the important things when analyzing Apple and qualifying how Apple looks is to understand what the real trend in Apple is and understand what the market's pricing in. Right? One of the things, just like we had talked about just now with PayPal, if you looked at Apple on an as-reported basis, you would think that Apple had shrunk the last 2 years. You'd be worried Apple thinks that they've saturated the market and they're trying to defend their economic moat, and so they're going to not grow massively, they're going to pull back. In reality, Apple grew by an average of around 25% a year the last 2 years. It is still a high growth company, hence why it can get a uniform accounting PE of almost 20 times. On top of that, you'd think that returns were way lower last year than they actually were. But the more important thing here with Apple, when we qualify whether or not we think Apple looks cheap or not at a 2.2 or 1.2 or 1.4 trillion dollar valuation, is understanding the trend in Apple's returns. On an as-reported basis, Apple's ROA has been flat the last 5 years. You would think Apple has basically just been bobbing along, growing, not growing, just trying to defend its economic moat. In reality, Apple has been investing aggressively, but into a declining ROA business. Fundamentally, their service business is a lower ROA than the legacy iPhone business, which makes sense because very few companies in the world consistently can have an over 100% ROA like Apple used to have. But what's interesting here is we can see when we understand that this company isn't shrinking and has declining but strong returns, we can put in context what's going on here in terms of the market expecting asset ROAs to basically be cut in half and asset growth to be around 20% a year. And we can say, you know what? ROAs did get cut in half the last 4 years. As they continue to compete and move into new areas like services, maybe that ROA drop makes sense as long as they're going to continue to invest in growth. But right, if you were looking at the as reported metrics, you would think that both of those numbers are completely wrong. You'd say, no, this isn't a company that has strong declining returns because they're growing massively. You'd say this is a low return business that's actually shrinking to make sure to preserve those returns. You'd misunderstand Apple's profitability, and actually more important than the profitability, you'd misunderstand Apple's strategy even. Right? And this is the problem with as reported metrics. When you try to tie them to a company's performance, to a company's strategy and what management talks about, often you'll get answers that just don't make sense. You've got a question which is, hey, Apple is growing as they're growing into services, growing into wearables and everything else. How is that impacting their business? And you'd look at this and you'd say, wait, no, they're not growing, they're shrinking. And you'd actually misunderstand this company's real strategy.
Valens Research, the world's leading source for uniform financial analytics.